Most people planning for retirement think they have to choose, do I want to be rich later, or get paid now? What if that choice is quietly costing you close to $1 million? I ran a 20-year test using some of the most popular ETFs, including SPY and QQQ, and the result completely flipped the way I think about retirement strategy.
You know, when we're planning for retirement, we often face this huge question. Should I go for growth with ETFs like SPY and QQQ, or should I chase that high monthly income with funds like SPYI and QQQI? But what if I told you that framing it as a choice, well, that's the mistake? Okay, let's really get into this because the stakes for your retirement are frankly massive. This conventional wisdom that forces you to pick one lane, growth or income, could literally cost you almost $1 million in your final nest egg. Yeah, you heard that right. So let's break down exactly why this happens and, more importantly, what we can do about it. So here's the classic dilemma, right? On one side, you've got pure, unadulterated growth. We're talking maximum upside, but pretty much zero income to speak of along the way. On the other side, you have these funds built to spit out a nice high monthly income. But, and this is a big but, that comes at the cost of some serious growth potential. So what actually wins in the long run? To get a real answer, we're going to run a little experiment. A 20-year portfolio race based on real historical data. We'll start with a hypothetical 100 grand and see how 3 totally different strategies play out over 2 decades. And just to keep it simple, no extra money is added. We're just letting that initial investment do its thing. All right, in corner 1, we have our all-growth contender. This portfolio is a simple 50-50 split between SPY and QQQ, tracking the big players in the S&P 500 and the NASDAQ 100. And in corner 2, we have all income, using that same focused 50-50 split, but this time with their high-yield cousins, SPYI and QQII. This is a pure showdown, total return versus cash flow. And, of course, we need a third contender. This is the one that seems like the most logical compromise, right? The hybrid model. This strategy basically says, hey, why choose? And it splits the investment 4 ways, 25% into each of those funds we mentioned. It's aiming for a little bit of everything right from the get-go. So, let's see who crosses the finish line first. Okay, let's fast forward. 20 years have flown by, the dividends have been reinvested, the markets have done their thing, and now it's time to look at the cold, hard numbers. This is where we see the real trade-offs each strategy forced our investor to make. And we have a clear winner, at least when it comes to building wealth. The all-growth portfolio, it didn't just grow, it exploded. That initial $100,000 turned into over $2.4 million. I mean, wow, that is a massive testament to the raw power of compounding when you just let growth run. Now, the all-income portfolio did pretty darn well for itself too, ending up with a very respectable $1.5 million. All those high dividends being reinvested really added up. But, as you can see, it's just not in the same league as the growth strategy. And this chart just says it all, doesn't it? This is that nearly $1 million mistake we talked about at the beginning. By chasing income from day one, this investor left over $900,000 on the table. That is a genuinely life-changing amount of money. But of course, the final balance isn't the whole story, is it? Let's look at the full picture because this is where it gets tricky. That huge growth portfolio, at retirement, it's only spinning off about $1,700 a month. Meanwhile, the smaller income portfolio is an absolute cash machine, kicking out an incredible $15,000 a month. And the hybrid? Well, it's stuck in the middle. Not the biggest portfolio, and not the highest income. It feels like an impossible choice. But what if you don't actually have to choose? What if there's a smarter, more dynamic approach that lets you have your cake and eat it too? This is where we stop thinking about our portfolio as a static thing and start thinking about how our needs change over time. It's called the pivot strategy, and honestly, it's beautifully simple. For your entire accumulation phase, that whole 20 years, you go all in on growth. That's it. You don't worry about income. Your single job is to make the pie as big as humanly possible. Then and only then, when you're ready to retire and actually need the income, you pivot. You reallocate that massive portfolio into a mix of assets that can pay the bills. See what we did there? You're not choosing between a big pile of money and a big monthly check. You're sequencing them. You use the absolute best tool for the job of accumulation, which is growth, and then later you switch to the best tools for distribution, which is that hybrid of growth and income. So the whole point is this. You let your money grow to its absolute peak potential first. After that's done, you shift gears and turn that massive pile of wealth into a powerful income stream. As the source material puts it so perfectly, you've maximized your growth and capitalized on a lot of income. And here is the incredible result. The pivot strategy lets you walk into retirement with the full $2.46 million from the growth phase. And after you pivot to a balanced model, it's generating $13,000 a month. Just look at that. You get almost the same income as the all-income strategy, but you're starting with a portfolio that's $900,000 larger. You didn't have to choose, you actually got both. Oh, but it gets even better. Seriously. Because half your money is still invested for growth, your nest egg doesn't just sit there getting drained. No, it keeps working for you, compounding and growing deep into your retirement years. In fact, get this. After just 10 years of being retired, while taking out that $13,000 a month the whole time, the portfolio could actually more than double. This could push your potential monthly income up to a staggering $30,000. That is the power of getting the sequence right. Grow first, then pivot to income. So the real takeaway here is that a static, one-size-fits-all approach just doesn't cut it. The best strategy is often the one that adapts as your life changes. It's about prioritizing growth when that's your job and then skillfully pivoting to create income when you need it. Which kind of leaves us with one final question you should ask yourself. Your investment needs change over time. Has your strategy?
Here's the part nobody tells you. The best performing strategy isn't actually one of the three we just tested. Even crazier? The story doesn't end at retirement, that's actually where it starts. If this changed how you think about investing, subscribe, because most people are still stuck choosing between growth and income, when the real edge is knowing when to use each. And before you invest $1, go back, run your own numbers, and build a strategy that actually evolves with your life.